Started. Hello and welcome to another Tax Foundation Talking Tax Reform discussion. Today we'll be talking about a holiday tradition known as tax extenders, in which Congress considers many expiring and temporary tax policies for possible extension. Today we're going to talk about what that means, and as well as what's in play this year and what potential there is for a deal. I'm Will McBride, Vice President of Federal Tax Policy, and Stephen J. Eaton, Fellow in Economics of the Tax Foundation. I'll be the moderator of the discussion, and we are joined by two expert panelists. First, Erica York, Senior Economist and Research Manager of the Tax Foundation, will give us some background on tax extenders and discuss how the Tax Cuts and Jobs Act introduced some major temporary business provisions that are under consideration this year, as well talk about how the pandemic relief packages added more temporary items to the mix, including an expanded child tax credit. Second, we are joined by Tom Gannon, Chief Government Relations Officer at H&R Block. He'll give us some perspective on what he's seen from taxpayers trying to utilize and comply with these provisions, and as well give us an outlook on the legislative potential. Before we start, two housekeeping items. This webinar is being recorded and will be available on our website for later viewing. All attendees are muted, but feel free to ask questions using the Q&A button on the bottom banner. When asking questions, please include your name and organization and the panelist your question is directed to. Okay, with that, let's go ahead and start with the first question. First, for Erica and then Tom, please give us a little more background on the current extenders, how we got here, and what the current state of play is.
Yeah, thanks, Will. So this year, we're really facing three different groups of tax policies that are expiring or have been expired that Congress may act on, probably not this week, but maybe January when they return to town. And so the first of those groups is the perennial tax extenders, these policies that date back many years, sometimes even decades, that have been temporarily renewed time and time again. And so that group of policies has been sitting expired since the end of 2021. Then we also have some new extenders introduced by the Tax Cuts and Jobs Act of 2017. And so it made tons of reforms to individual taxes and to business taxes, and a lot of those were temporary and phase out. So on the business side, we have three really important provisions. Two of those changed in 2022. So that is how businesses get to recognize their expenses for research and development. Previously, for really all of the existence of the tax code that was applicable to R&D, businesses just deducted those costs in the year that they were incurred. We're mainly talking about the employer costs, so the cost of employing people who do research and development type work. The TCJA, as a pay-for, introduced a requirement for businesses to take those deductions either over 5 years for domestic R&D or 15 years for foreign R&D. And that's a big change that increases the tax burden on R&D. That took place in 2022, and Congress has not acted to fix that yet. 2022 also saw a change to interest deductions for businesses. So the limitation placed on those became more restrictive, which increases the cost of capital for businesses by restricting their interest deductions even tighter. And then this year, starting in 2023, we saw the phase out of full expensing for business purchases of physical assets like machinery and equipment start to phase out. So rather than be able to deduct that full cost in the year that a business buys a machine or a piece of equipment or software, they can only take a partial deduction for that, and the rest is deducted over time. And that's scheduled to get more restrictive going forward. So those are the three big TCJA business provisions in the mix. And then in the pandemic, we saw an expansion of lots of different tax policies on a temporary basis to provide relief to households and businesses. One of the big ones was the expansion of the child tax credit. It was made fully refundable. The amount was increased significantly from its current $2,000 max to $3,600 or $3,000, and it was paid out on a monthly basis. And since that expired after the end of 2021, there has been a push in Congress to do some form of bringing that back, whether it's the full expansion we saw in the pandemic is less likely just because that's so expensive and because there's not bipartisan agreement for that path on the CTC. But some changes to the CTC are likely in the mix as another component to what Congress might consider in a tax package in the short term.
Great. Tom?
Will, thanks for having me. Yeah, Erica covered a lot of kind of the current state of play. I'll just say, like, as a reminder, it's been, I think, 3 years since Congress has passed a tax extenders package of some form. Many of the items that Erica listed were obviously a part of that last package, or one, kind of shortly before that. As a company, we don't, as an advocacy matter, lobby on individual or advocate on individual tax policy changes. We're really focused on sort of how they're implemented, how they're administered. Certainly, we serve 20.5 million households across the US every year. And so a lot of the tax changes, particularly at the individual level or those impacting small businesses, including some of the ones that in the current extenders package have been either recently expired or are being discussed. Those obviously have direct impacts on our clients and are something that we follow closely. I think, as a tax prep company, we have a perspective about sort of the right way to administer and implement those tax changes so that taxpayers get the maximum benefit. And so that's kind of where we tend to focus our energies and kind of lend our voice as Congress is looking at different ways to provide tax relief, both to individuals and small businesses and elsewhere.
Got it. Makes sense. So the second question here, I think probably a major concern this year with the any potential deal is the fiscal cost. This year we've got a $2 trillion deficit, and of course it's that deficits are projected to go higher and higher in subsequent years, and we've got a real concern about the overall debt level. Can Erica and Tom, can you give us any insights there? Particularly Erica, I think you've got some good numbers you can share on our modeling of these provisions and the revenue cost.
Yeah, so we've heard reports of this $100 billion cost to be split evenly between the business provisions under consideration from the TCJA and an expansion of the child tax credit. That seems to line up with retroactive application of all of the provisions. So on the business side, that would be like going back to 2022 and then including the change for this year, as well as forward 2024 and 2025 to provide essentially, full expensing for R&D, less restrictive limitation on the interest deduction, full expensing for capital investment, and then some form of child tax credit expansion as well. That's what broadly lines up with that $100 billion figure. We've estimated that if you were to make those 3 business changes on a permanent basis without applying them retroactively, so starting in 2024, providing this better cost recovery treatment and less restrictive interest limitation, it would reduce federal tax revenue by a little over $700 billion over the decade. So we're talking about fairly substantial tax provisions here, which is a bit different from the tax extenders packages we've seen in the past. Tom mentioned there hasn't been any movement on extenders for the past about 3 years. Some of the extenders packages we saw post-tax reform did cost more. There were a couple that cost more than $100 billion, but that's because they were looking at longer term or even in some cases permanent solutions for these temporary provisions, not just temporary and retroactive extensions. So I think that's one distinction here. On the child tax credit, and and Tom can probably speak to this some too, but it can get very expensive very fast just because of the number of households with children that we're talking about in the United States. So what can seem like maybe a relatively small change to the credit can actually have a large fiscal impact because of the number of people who qualify for the provision. So for instance, if we were talking about fully restoring the pandemic style CTC for this year and for the next couple of years, that's roughly $100 billion cost per year to do that. After 2025, it becomes even more expensive because that baseline child tax credit set by the TCJA is scheduled to become smaller. So we're talking about more than $100 billion a year if we were doing these things on a permanent basis. And I think that points to, the real reason why Congress tends to do extenders on a temporary basis is because it looks less expensive to make these changes for 1 or 2 years than it does to make them a permanent part of the tax code.
Indeed, indeed. I'm recalling the PATH Act from 2015, in which the R&D credit, which was like prior to that a perennial, major centerpiece of the extenders deal, going back to 1981. I think in 1 year it actually fully expired and was finally made permanent in 2015. But anyway, so this is a long tradition we're talking about. Tom, any other thoughts on that before we move on?
Yeah, I mean, look, certainly, tax relief, targeted tax relief, like there is, there is the question of what's the cost and how many either businesses or individuals, taxpayers that relief supports. And so those are really big considerations in terms of trying to get to some sort of package. The other, I think, thing to think about is there is a certain level of certainty that small businesses in particular can get with kind of the right approach to tax relief. And so how do you kind of balance that vis-a-vis the cost and the implementation of changes that Congress might consider. And so those are certainly all factors that that weigh in here when you're looking to find the right move forward on a tax extenders or tax relief package.
Makes sense. Okay, so let's talk about a little more about the business items and the child tax credit and the other potential provisions, how they might potentially affect business investment as well as work incentives, and then how any as well any potential deal or no deal could affect the upcoming filing season, and the timing of that deal, as well the utilization of these provisions by taxpayers. Start with Erica and then Tom.
Yeah, if the goal of a tax policy, any tax policy in general, is to encourage an individual or a business to do some activity, that individual or business needs to know whether that tax policy is even in place and for how long it's going to be in place. And so when we're in a world of temporary tax provisions that have been allowed to lapse, that might be reinstated months or even years later, they're not going to be effective in accomplishing whatever the goal is, just because of the uncertainty. That uncertainty itself, operates as a tax almost. It can delay or discourage behaviors from occurring because people don't know how to plan for their decisions and what the tax implications will be. So if we're talking about retroactive extension of policies, people can't go back in time and make different decisions based on, a tax change today that's applying to 2022. So the goal of retroactive tax policy can't be to incentivize activity because that activity has already been set in stone. What's important is what are the incentives moving forward? And so especially when it comes to these provisions like R&D expensing for physical capital, business businesses need to know what that tax treatment is so that they can plan for their business expansions, for the activities that they want to do. And I think this is also should be part of the broader conversations that we're having, with these incentives that have been recently put in place for green energy investment, for semiconductor investment, the phase out of bonus depreciation and the amortization of R&D cuts in the exact opposite direction of what the goals of those policies are. So it makes sense to align broader tax policy in the direction that we want to see things go, which is increased domestic investment. If it's done on a permanent basis, this better cost recovery treatment through R&D, through expensing is one of the most cost-effective policies that lawmakers have available in order to incentivize investment here. And so it's really important to get that done sooner rather than later and on a permanent basis so that businesses have the certainty that they need. And then there's also, there's the question of, does a temporary extension help? It does some. It improves incentives now. And to the extent that it keeps these policies in the conversation, that it helps align them with these broader tax policy discussions that we know we're going to be having at the end of 2025. I think that's an important element to consider here too, just given the circumstances of where the broader tax code is at right now. And then when we think about the changing work incentives under the child tax credit, that's been a really big area of debate over the past couple of years since we saw the full refundability provided with the pandemic era tax credit, which substantially and fundamentally changed how the child tax credit has always been provided. So historically, it has always phased in with earned income, which reduces marginal tax rates for people along that phase-in rate. So when you make over a certain level of income, the next dollar that you earned is matched with 15 cents of child tax credit, which boosts your incentive to work additional hours. At the same time, by phasing out, it has the reverse effect. So for higher income households who are in that phase out range, an additional dollar of income is met with a reduction in their actual take home pay because their child tax credit is phasing out, and that's a disincentive for work. And so depending how you change the structure of the child tax credit, you can either increase or decrease the work incentives that are associated with those changes in marginal tax rates. I think we can debate the magnitude of those, but those effects do exist, and they should be part of the conversation as we're thinking about what does the child tax credit look like going forward.
Got it. Tom?
Yeah, looking at child tax credit, for example, certainly, I think we, as a tax prep company, have seen the impact of changes in tax policy and law on taxpayers and clients that we serve. As I mentioned, we serve tens of millions of households every year. And so, if you look at some of the numbers around child tax credit, in 2022, we served about a little over 5 million households who claimed the child tax credit. Those 5 or a little more than 5 million households, the total in refundable and non-refundable child tax credits amounted to about $15.5 billion in dollars saved for taxpayers claiming this credit. When there are changes to tax laws, there obviously are impacts in terms of tax credits like CTC and the impact to households. And so last season, we saw about the same number of households, maybe a little less, claiming CTC, but the total dollars went from about $15.5 billion to around $13 billion. And that $2.5 billion difference was exclusively attributable to changes in tax law. I think one of the things that people need to kind of remember is, there's impacts on tax law at both the federal and the state level. And in some cases, states have different sort of ways of providing credits to taxpayers that are either different or entirely new in terms of credits that you may or may not be eligible for at the federal level. And so, anytime you have changes in one or the other, there's obviously going to be direct impacts. And so, allowing people to fully take advantage of credits they're entitled to, and figuring out kind of the right way to implement those tax changes, I think, are really important in terms of impacts to households and individuals.
Yeah, that's interesting to keep in mind that states are doing their own policies and very often piggybacking on the federal policies. And I know a lot of states have their own child tax credits in particular, as well as other policies targeting families. Okay, well, let's turn to the issue of the SALT cap, which has created a lot of consternation on Capitol Hill. So this is a particular interest this year for many taxpayers and lawmakers in high tax states. It's been part of some legislative packages earlier in the year, and could come back into the tax extender discussion. Related ideas is the idea of expanding the standard deduction. A so-called bonus standard deduction was introduced in a Ways and Means package earlier this year. How might either of these policies or something else related come into play in this any potential upcoming tax deal? Erica, you go first, and then Tom again.
I wish the conversation we were having around SALT was that it was going to be included as a pay for these other provisions. Of course, SALT right now is limited to $10,000, whether you're a single filer or joint filer. That's the limitation on the itemized deduction. That was introduced by the TCJA and took effect in 2018, and that's scheduled to expire after the end of 2025. So if we completely got rid of the SALT deduction, fully eliminated the deduction itself, over the next 2 years, while that cap is scheduled to still be in place, that could raise roughly $30 billion a year. So it could pay for this, almost pay for this roughly $100 billion tax extender package under consideration. But of course, getting rid of SALT is not the discussion that lawmakers are having. Instead, they're having, in some circles, discussions of how can we provide relief for the SALT cap. So raising the SALT cap. Some iterations of this have been floated as part of the Build Back Better debates. We've seen Senator Bernie Sanders introduce or float an idea to increase the SALT cap for taxpayers making under $400,000. We even saw discussions of this in the speakership race in the House more recently. And the designs have all differed, but have been some form of increasing the size of the cap and providing marriage penalty relief, so doubling the size of the cap for joint filers. My colleague Garrett Watson has just put out a really good analysis on this, modeling 5 different options and showing the revenue trade-offs, the distributional trade-offs. And the takeaway from all of those is that it costs a lot of revenue to raise the SALT cap, and the benefits of that revenue primarily flow to higher income earners. Basically, across any iteration, the bottom 60% of households don't really see much benefit at all from a higher SALT cap. That's going to the top 20% of earners for the most part. He's also done some modeling showing the implications of these state level workarounds that have been permitted since the SALT cap went into place. So that cap only applies to individual taxpayers. It doesn't apply to business level SALT. And at the state level, some states have created workarounds where individuals can pay their individual tax liability at the pass-through business level, which essentially allows them to work around this cap. And he's estimated that that's reducing the federal revenue raised by the SALT cap by about 20%. So that's another area where if federal lawmakers could crack down on these workarounds, they could potentially raise some more revenue to offset the cost of better reforms. Whether we actually see something on SALT in this year-end/January tax package. I'm less certain. In the past, we've seen some lawmakers, they have this slogan, no salt, no deal, that's been raised when different tax packages come around. I haven't really seen that be brought up surrounding this year-end tax package, but you never know.
Tom, any thoughts on that?
Yeah, no, look, certainly like it's a big question for kind of the conversation around current extenders and the status of what changes might be made. As Erica said, more likely early next year as opposed to end of this year. It obviously is something that is very top of mind and has a lot of impact in certain states. And so, that is certainly a consideration in the overall conversation about what to do or not do with respect to the cap. I think certainty is really important both for taxpayers and frankly for both federal government and state governments from a revenue standpoint. And so those factors all play into the conversation with respect to SALT and what to do moving forward.
Yeah, makes sense. Okay, so moving on to another policy that is changing right now considerably. A set of policies that is the Secure 2.0 legislation that substantially altered a lot of the rules relating to 401ks and other tax-advantaged savings accounts, and that was implemented or enacted about 1 year ago, but has waves of effects going into place, including some in 2 weeks from now, January 1, and some in subsequent years. And as well, there's some regulatory guidance that has been recently issued on this legislation. How might this enter the discussion? And we'll again start with Erica and then Tom.
So we have a number of changes that have already been enacted going to take place starting in January. And you can kind of split them maybe into three groups. The first group is some new types of accounts that are going to potentially be offered depending on whether employers offer them. There's a starter 401k that has automatic enrollment that employers can offer to automatically opt their employees into having a 401k. It's got smaller contribution limits on it than a regular 401k does now. There's also going to be some changes for emergency savings. So again, an optional feature for employers that already maintain retirement accounts is to add this emergency savings account to it. It would be a Roth style account that, again, we would see automatic enrollment into to allow people to save up to $2,500 really for any purpose. So rather than having restrictions like many accounts do now, it has to be for retirement savings, you have to be a certain age, it has to be for education or health related savings. It's really open-ended, and there are some limitations as to how many withdrawals you can make from the account, but the purpose is not restricted to specific uses of the funds. There's also some other flexibilities being added for people who have emergencies pop up to take smaller withdrawals from a retirement account. And if they repay that amount within a certain time period, they don't face the normal penalties that you would face from early withdrawals from a retirement account. There are changes to the savers credit that have taken place and then will take place in a few years as well, expanding the availability of that credit, and eventually changing it to, rather than being a tax credit that you receive on your tax return to offset your tax liability, it will be transformed into an actual deposit into your retirement account. So the government is essentially going to match your retirement account contributions. A lot of changes to catch-up contributions as well. Those are now being inflation indexed, so that the amount that you can contribute for people 50 and older isn't eroding over time with inflation. And coming in a few years, we'll see something called a super catch-up, which will allow taxpayers 60 to 63 to make an additional catch-up contribution to their retirement accounts. So lots of changes, lots of moving pieces on the edges of what's already a really complex retirement system, with the idea of trying to help people save more for emergencies and receive less penalties if they do need to access the amounts that they have saved. One thing that I think could have been an impetus for Congress to enact a year-end tax bill, but has been taken care of by the IRS, was a drafting error, a technical glitch in the language of Secure 2.0, which would have accidentally eliminated all catch-up contributions, which was not the intent of the law. So in the summer, IRS clarified, no, we're not going to follow the letter of the law. We know that wasn't what was supposed to happen. But just in the last week or so, lawmakers have been circulating some draft language of a technical corrections bill for Secure 2.0 to clear up in legislative language to codify the fix for that and some other clerical issues. So we could potentially see that be included, but it's less pressing since IRS said we're not actually going to enforce that glitch.
Right. In particular, for those that will be 50 or older in the new year, the concern was that the original legislation, like you said, would have prevented any catch-up contributions effectively, as I understand it, for in part because it required them to go to Roth accounts. And I think most the problem is, one of the problems is that most companies do not have these accounts set up, and that takes some time for administrators to do that. And so the IRS, like you said, gave some relief there, particularly 2 years of relief, so that for the next 2 years, 2024 and 2025, taxpayers will continue to be able to make catch-up contributions in that are deductible into their 401ks. Tom, any thoughts on that?
Yeah, look, we obviously serve a broad spectrum of taxpayers and households, both in the context of tax prep and tax time needs, but also in the context of small businesses. And, if you look at issues around financial health and emergency savings, and allowing individuals and families to have a path to build financial wealth and to save for a rainy day fund and to help, save for a down payment or help support their kids, going to college. Like, those are all, from our perspective, really important goals in an effort to improve people's financial health. And so certainly from our standpoint, Secure 2.0 has a lot of good new tools for households and families that are on that financial health journey to be able to do the things they need to do financially to help support their families. Tax time is for many households, one of the most important times of the year from a financial health perspective. And so giving families and households the ability to navigate that time in a way that allows them to be in the driver's seat and really improve their financial health, whether it's through emergency savings or other financial goals they have, we think is really important in a really productive way from a policy perspective to support household growth. And so certainly Secure 2.0 does has a number of provisions that help accomplish that goal.
Got it. Got it. Erica, I don't know if you mentioned it, but we do have a blog post out on this topic just yesterday on Secure 2.0. There's a lot going on there, so we tried to summarize the major items in the blog post and mention the fact that it is, as I agree with you, Tom, that it's very important to address the needs of taxpayers, their need to save, build financial wealth for various reasons, not just retirement. The challenge with Secure 2.0 is the complexity of it, as you'll see in the blog post, which we tried to make simple. And it's not so simple to explain these rules, as it turns out. So that means it's not so simple to actually understand them and use them. So I'm afraid a lot of taxpayers will be dissuaded from even trying to utilize many of these provisions. So there we provide in the blog post an alternative approach, which is known as universal savings accounts, and these are really more open-ended accounts, tax-advantaged accounts that allow taxpayers to save for any purpose, and there's without penalty. And with that, let's turn to another topic that may enter the discussion. The 1099-K information reporting threshold. This is affecting so-called gig economy workers, and that threshold was changed recently, lowered considerably, such that number one, it affects many more taxpayers, and number two, it is potentially deluging the IRS with information returns. And so the implementation of this has been in substantial flux over the last couple of years. Tell us how this may influence the deal. Give us a little background on it. And as well, any other items that may come into the discussion that maybe don't have a huge fiscal cost, but have a big impact nonetheless on certain taxpayers, if only in terms of compliance essentially compliance and understanding the law. Tom, let's start with you this time, and then Erica.
Yeah, sure. So yeah, look, Will, as you mentioned, there were changes to the original law that the IRS recently put out, including delaying the implementation of it for an additional year, and then changing the threshold from the current $600 that was passed by Congress and raising that threshold to $5,000. This issue from a tax preparer's perspective is something that we have been following closely. As I mentioned before, we don't, as an organization, tend to weigh in on tax policy, and so we were less focused on changes in the law or statute, and more focused on how do you implement this, how do you administer this, how do you support taxpayers who are going to be receiving these forms, and make sure that there's clear guidance in terms of how to support taxpayers that some of which may have potentially been receiving these for the first time. And so I think from our perspective, it's always really helpful as both a taxpayer and a tax preparer to have that clarity early or sooner rather than later. Obviously, as tax changes come about towards the end of the year that may impact upcoming tax season, there's adjustments that need to be made to those tax changes. And we certainly stand as a tax preparer ready to make those changes and support clients that we serve. But I think, the guidance and clarity that you can get is really important.
Got it. Erica, any thoughts on that?
Yeah, I agree that the sooner, if we're not going to stick with the $600 threshold, if it's going to be something higher, Congress needs to act on that and clarify it. And I think they need to land somewhere in the middle. You don't want the information reporting threshold to be so low that people are getting these returns that they don't need them, that it's catching transactions that aren't actually representative of income that's been earned. That's confusing for taxpayers and for the IRS. And so trying to set that threshold at a place where it helps people who do need to pay taxes on income that they're earning know the numbers that they need to know, but without catching people into this information reporting that doesn't actually apply to them. So I think the more work needs to be done on that front to get it at an appropriate level and provide the guidance that people need.
Got it. Well, okay, let's take some of the questions from the audience that we're getting, and some of the there's a question about the charitable deduction that was introduced, the above the line charitable deduction during the pandemic that expired, I think, maybe 2 years ago. Can you give us any thoughts you have on how that may come back as part of this discussion? Erica, let's start with you.
Yeah, I haven't heard anything specific on that. I have seen some reporting of lawmakers saying if they get to an agreement on these big four, so the three TCJA business provisions and the CTC, then that could open the door for a lot of additional, probably smaller tax provisions to be included in an extenders package. Whether that above the line charitable deduction is one of those, I don't know, but I think certainly if we see a tax package and an agreement on those four, it opens the door for smaller provisions.
Yeah, I would agree. I don't know that I've heard a lot of conversation on that particular provision or topic. But, certainly you kind of have to address some of the bigger items, as Erica said, before, you can get to other provisions that are potentially smaller and have already expired.
Okay. Another one mentioned here from the audience is any tax changes that impact real estate, especially in rural areas. Is that anything we're hearing that's potentially related to that could come into the mix?
Yeah, so similar to what I just said, the door opening if there's agreement on the big four, we've seen a push really in the past week or two for changes to the low income housing tax credit to potentially be included in a tax package, as well as considering either expansions or additional tax credits for housing, for rental relief. So there's a potential there. Some of those proposals do have bipartisan support, like changes to the low income housing tax credit. So, possibility if we see movement on these big four for something like that to be in the mix as well.
Got it.
Yeah. I think, certainly where there's bipartisan interest in particular credits or approaches to changes in tax policy, those tend to have focus and attention that I think makes a lot of sense in terms of like trying to arrive at the list of the possible in terms of tax changes. I'll also point out, as it relates to residential tax credits or property tax credits, there's obviously a lot of movement year to year at the state or local level. And so, we see every year a lot of changes across different jurisdictions at the local level around that certainly impact the residential market. And obviously changes in property tax or property tax relief is one big area for that. And I think, it's fair to say that those types of tax changes will continue to see from year to year, separate and apart from what Congress may do around specific changes in tax law.
Got it. Okay, another one that I have not heard mentioned as part of the debate this year, but it's certainly affecting a lot of seniors, and as indicated from someone tuning in here today, who's a taxpayer, wondering if the current law threshold for determining the taxation of Social Security benefits will be adjusted in some way for inflation, I think is what is being thought about here, because under current law, that threshold is not adjusted for inflation and has not been adjusted for inflation, I think, for a long time, maybe since the early 80s. And as part of the Social Security deal that was made back then. And so it certainly means that a larger and larger portion of Social Security benefits are subject to tax every year, affecting more and more taxpayers. Any thoughts on how that might come into play? We heard anything, Erica?
Haven't heard anything. Yeah, those thresholds were originally established in the early 80s. They were updated once for inflation in 1993, but they've been stuck at that same level since. So of course, a lot of inflation has occurred over that period, and especially in the last few years. Ideally, that is something we would see be updated for inflation. Inflation adjusts those brackets just like we do the broader tax code. But I have not seen or heard any mention of that as part of the considerations now.
Okay, Tom?
Yeah, I don't think I would agree. I haven't heard much conversation as it relates to that. Obviously, letting seniors keep more of their money, in particular benefits that they've earned, makes a lot of sense. We've obviously been at a period of persistent inflation, and that does obviously have an impact, particularly for people who are on fixed incomes or primarily dependent upon Social Security. But it hasn't, as an idea or a change, it hasn't been something that I've heard much discussion on recently.
Got it. Okay, so then there's a question about the big question, I suppose. It's a 2025 question, really. What's going to happen to the expiring individual tax cuts from the Tax Cuts and Jobs Act? That is essentially the entire individual tax code expires in 2025, at the end of 2025, and we're going to have the biggest fiscal cliff in a long time, maybe ever. There's certainly going to be a forcing mechanism for a lot of tax legislation. When that might happen, we don't know. But any thoughts on how that may be addressed potentially as part of any upcoming tax legislation as part of any tax extenders deal? Erica?
Yeah, I don't think there's any chance at all of TCJA expirations being addressed right now. If the conversations we're having now are any indication, we're talking about tax changes that took place in 2022, and we're just now getting around to maybe fixing those at the end of 2023 or the beginning of 2024. So tax policy, unfortunately, is not something that operates, with a lot of planning in advance. It happens at the last minute and is motivated by deadlines or even lapsed deadlines. I do think we're seeing some influence of those expirations in this conversation, though, and that's why we're seeing these the floated expiration dates of what's being extended now set to align with these broader expirations at the end of 2025. So rather than seeing lawmakers offer permanent solutions for things like, what are we going to do with the child tax credit? What are we going to do with R&D expensing? We're talking about, let's punt that ultimate decision to the end of 2025 to align it with these broader expirations. And then we'll have that big conversation at the end of 2025, probably, of what's the tax code going to look like for the next decade.
Right. Tom?
Yeah, I would agree. I mean, I think it's not something that like we've heard is going to be necessarily addressed in the short term. It obviously will require a lot of conversation in Congress, and getting to a consensus on a path forward on something that you know, will have an impact on a lot of taxpayers is something that's going to take some time. And so I would sort of agree with Erica's kind of timing in terms of getting to see like how this debate plays out. But in the short term, I think it's really challenging to arrive at a path forward on something that really has such a big impact on households across the country.
Sure, sure. Yeah, well, there's time for discussing that issue. Certainly, we'll be issuing some publications on it over the next year, and as well, we've already published some estimates from our model of what permanence for those individual provisions would look like. So you can see that on our website. We published that about a month ago, right, Erica?
Yeah.
Okay, so last thing, there was a question from the audience about, in particular the child credit, what the potential is there for that being part of this discussion. I think we've talked about it already to a large degree, but is there anything else we want to touch on there? The various parts of it that might there's a lot of talk about complexity. There's a lot of complexity to the child credit. A lot of different levers that can be pulled to address different things, distributional effects. Like Erica, you were talking about the work incentives, the stability of the tax code in terms, is it going to be a 1-year extension? Is it going to be an experimental type of child credit that we saw in 2021 that was issued as a partially issued as a monthly payment and then reconciled during the tax filing season. What do we think about all that, and what are we hearing? Are there any specific? Number one, are we hearing any specifics? Is there actual legislation or anything concrete that we can point to in the way of some sort of adjustment of the child tax credit that could enter this discussion? Erica, let's start with you on that.
I don't think there's anything concrete yet, but I think lawmakers are going to be looking at retroactive relief here too. I think monthly payments are off the table. I think full restoration of a 2021 style credit is off the table. I think we're going to see something that still retains the phase-in and thus the work incentive within the design, but maybe we're talking about like lowering the refundability, the phase-in threshold from $2,500 to the first dollar of income. Maybe we're getting rid of the cap on how much of the credit is refundable, so making the full $2,000 phase-in. Maybe even increasing the phase-in rate from 15% to something a little bit faster. But I think to ensure that taxpayers see a benefit from it right now, I think we'll see it change for 2023 as well. So when people start filing their taxes in early 2024 for what happened in 2023, they'll get the larger credit. If we get to an agreement, I think that's what the timing of it will be. Otherwise, an agreement now on the CTC for 2024 means people wouldn't see the benefit of that until they're filing their taxes in early 2025. And I think lawmakers want that relief to happen on a faster timeline, if it happens at all.
All right, great. Tom?
Yeah, I mean, I guess, I would just say, based upon what we see with clients that we serve and households that we see during tax time every year, I think whether you're talking about CTC specifically or another type of credit that a taxpayer might be able to take advantage of, the important things for us are really around clarity. I think sometimes simplicity in terms of how the credit is administered from a taxpayer perspective is helpful. Obviously there sometimes is a lot of complexity in the tax code. Applicability is sometimes an important consideration, but with respect to something like the child tax credit that impacts so many taxpayers and households out there, I think while I would agree, haven't seen like specific proposals, I do think that lawmakers value the work historically that's been done on the child tax credit, understand the positive impact that it has on taxpayers and households, and kind of getting that right in a way that provides relief and clarity to taxpayers is I think a really important consideration from our standpoint.
Got it. All right, and the last minute, let's do a lightning round here. Predictions. What is your crystal ball prediction, and what should be the priority for lawmakers? Is it stability, simplicity, relief, something else? Erica, let's start with you, and then Tom.
Well, I think there's a better chance of getting to an actual tax package this year than there was last year, save that it's going to probably happen in January if it happens, because I think we see more bipartisan agreement on both the R&D and the CTC than we did last year. So I think there's the willingness there. There's the vehicle with government funding expiring January 19th. So it's certainly possible. In my ideal world, we would see this package be fiscally responsible, so a real pay for rather than relying on short-term extensions. And we would see certainty and stability prioritized as we're looking to improve investment incentives with R&D, with expensing, doing that on a longer time horizon and permanently addressing these things now rather than kicking the can down the road again should be the priority.
Got it. Tom?
Yeah, look, I'll just say, providing relief to taxpayers is always a good thing, particularly for everyday Americans that need that relief and certainty. I think it's clear that lawmakers do want to find a path forward, and so it's really just a question of how you do that, what's in the mix. Certainly, some of the provisions that Erica mentioned are sort of on that list. And I think we'll see in a very relatively short period of time what that looks like.
Excellent. All right, with that, we're going to wrap it up and thank our panelists, Erica York and Tom Gannon. I think this has been enlightening, and we now have something we can bet on over the holidays as to when or if a tax package may happen in the near future. All right, and as a reminder, this has been recorded, and you can find it on our website sometime in the near future. And thanks again for everyone joining us today, and enjoy your holiday. All right.
Thanks, Will. Good to be with you.